Speaking of retail real estate, its categories and participants are diverse, requiring structured thinking and analytical approaches. Daisy Huang summarizes the following analytical framework and participant dimensions. Each year, drawing on her extensive transaction experience in commercial real estate, as well as research reports from major industry leaders such as CBRE, she provides a snapshot of Canada's and Toronto's retail real estate markets, highlighting their current conditions and key indicators. All capital seeks profit, and the capitalization rate is the most critical indicator of a commercial real estate asset's value and return. It reflects changes over time in an asset class's valuation, income performance, and risk trends. The higher the risk of an asset, the higher its capitalization rate. Government bonds are considered risk-free assets, so their yields, or capitalization rates, are the lowest compared with other assets. Looking closely at capitalization rate trends across different types of commercial real estate in Canada, the typical risk ranking from lowest to highest is multifamily residential, industrial, retail, office, and hotel. Over the past 5 years, capitalization rates for retail stores have changed very little and have even declined somewhat recently, reflecting the market's recognition of their valuation levels. Looking at investment volumes across different types of commercial real estate, CBRE data shows that in the first quarter of 2025, retail store investment in Canada ranked in the middle among all categories, but recorded a significant increase compared with the historical average. In the Greater Toronto Area, retail store investment transaction volume in the first quarter of 2025 ranked second among all categories, behind only industrial and warehouse properties. Banks play a vital role in commercial real estate projects and are among the most sensitive to market shifts. Recently, banks have shown increased willingness to lend, signaling growing confidence in the sector. Over 90% of banks expect to increase lending to commercial real estate in 2025. Lenders have their preferences and risk biases. CBRE's latest survey shows banks prefer increasing loans to single-family homes, retail stores, and industrial properties. They intend to maintain lending for high-rise apartments and hotels and reduce loans for office buildings and development land. This aligns with credit risk assessments showing increasing risk for development land and office assets, while retail and industrial are considered lower risk. Moreover, 48% of lenders indicated a willingness to expand lending for retail properties, a significant jump from recent years. This is likely tied to the broader macroeconomic shift toward domestic consumption under changing tariff circumstances. Conclusion. Despite economic headwinds and unavoidable tariff adjustments with the U.S., uncertainty is decreasing. The U.S. Federal Reserve is likely to initiate rate cuts, which will ripple globally and lead to further rate cuts in Canada, providing a boost to industry, services, and commercial real estate, and serve as hedge against the headwind. While many real estate participants remain cautious, doing nothing is not an option. Strategic planning and activity within the industry continue as good deals and opportunities still emerge. The risks and valuations of various types of commercial real estate have changed significantly in recent years. Retail commercial real estate appears relatively more optimistic, with market activity expected to be more vibrant,